Hi, I'm David Witter, founder and CEO of Financial Harvest Wealth Advisors. And today I wanted to speak to one of the most senior concerns that we work with our clients on, which is preservation of wealth. How do I make wise investment decisions with my money? And specifically, given what's going on in the world right now and the world chaos that we're experiencing, why would I consider investing in a globally diversified portfolio? And to add to that, in 2014, U.S. equities, especially large cap, did extremely well when international underperformed. So does that beg a question, should we be globally diversified, and also should we make any adjustments to our portfolio? So let's dive in. Here we look at 2014, and there's 5 indices that we're showing here. On the far left-hand side, the S&P 500, many of you probably heard of that. That measures U.S. large cap stocks. Next to that is the Russell 2000, which is U.S. small cap. Next is the EAFE index, which is Europe, Asia, Far East. EAFE small, which would be international small, and then the emerging markets index. Notice that the S&P 500 did extremely well for 2014, putting up almost a 13% rate of return. Meanwhile, U.S. small cap was positive, but much less so. And look internationally. All 3 of those indices were negative for the year. What that means is if you had a globally diversified portfolio, your international exposure reduced or was a drag on the overall performance of your portfolio. So you may be asking, why would I invest globally, or why would I say globally diversified? Well, one thing to keep in mind is the last time we saw the U.S. large cap market dramatically outperform was in the late 90s. And if you overweighted in U.S. large due to the dot-com and also 9/11 occurring on U.S. soil, you were really penalized in 2000, 2001, a substantial pullback in the equity markets if you didn't have that international exposure. Now let's also look at the 2015 first quarter, because a lot of times what occurs is when we have one market outperform, then the next year it might revert back to the mean and underperform, and another market might start performing better. That's exactly what we saw so far here in the first quarter of 2015. Here we had the same 5 indices again. Notice the S&P 500 was still positive, but minimally so. And we saw U.S. small cap do dramatically well, almost a 4.3% return. International large, international small, both positive, and emerging markets was 5.5%. This shows that if you remain diversified globally, you are richly rewarded here in the first quarter with stronger returns from your international exposure. So let's sum it all up. Why would I invest globally? Well, the first thing is it often will reduce volatility. I mentioned before, if U.S. is up, maybe international is flat or down, but then the following year you may see those trends reverse. We call those dissimilar price movements. But if you add those dissimilar price movements together, it actually smooths out your portfolio line, which is less risk for the investor. Number 2 is there's, believe it or not, higher expected returns, especially in the emerging economies when you have a small allocation there. You can boost performance by having the global allocation. And number 3, which is really quite fascinating to me, if you take the 4 largest emerging economies, which is India, China, Indonesia, and Brazil, just those 4 countries alone, if you add their population together, they outnumber the U.S. economy or the U.S. population 12 to 1. Now, why would that be important? Think about it this way. That great population that outnumbers us 12 to 1 wants our lifestyle. They want energy, they want cell phones, they want technology, they want iPhones, they want food, they want infrastructure. All those things combined, there's a rising demand for products and services offered by global companies that are developing and innovating those new products and services. All that in the long run, a rising demand, a rising population, in the long run always is a plus for equities, and especially globally diversified equities. So remember, it does require remaining disciplined and being very purposeful, but if you stay diversified with your global equity portfolio in the long run, it does lead to wise investment decisions.